Chapter 7. The Role of Financial Markets and Liquidity. The winter of 2007 to 2008 proved to be a winter of discontent in global financial markets. Initially, the United States subprime mortgage problem created an insolvency problem for major underwriters. The exotic financial instruments that they created, such as mortgage-backed derivatives, lost liquidity and market value. This problem proved contagious as it spilled over to other exotic financial markets such as the auction rate securities markets 1 and the credit default swap markets 2. Alan Greenspan reflected the view of most well-known mainstream economists when, in his congressional testimony, he stated that he did not foresee the coming of the global financial crisis and could not explain why it occurred using well-established mainstream economic theory, including some Nobel Prize economic analysis. The facts were the United States subprime mortgage problem created an insolvency problem for major underwriters. The exotic financial instruments that these institutions created, such as mortgage-backed derivatives, lost liquidity and market value. This problem proved contagious as it spilled over to other financial markets such as the auction rate securities markets and the credit default swap markets. The auction rate markets, which had seen few failures in years, suddenly experienced over 1,000 failures in the early months of 2008. What caused this contagion to spill over, and what was the cause for this tremendous increase in market failures? The answer is simple. Economists and market participants had forgotten Keynes's liquidity preference theory and had, instead, swallowed hook, line, and sinker the belief that the classical efficient financial market theory is the useful model for understanding the operation of real-world financial markets. This efficient market theory indicates that all one has to do is to bring informed buyers and sellers together in an unregulated, free financial market, and the resulting financial market price will always adjust in an orderly manner to a price reflecting the known future value of the underlying assets. This known future was obtained by analyzing readily available existing information called market fundamentals, such as price-earnings ratios, risks of defaults, etc. These fundamentals is information readily available to all via modern computer reporting of market trends and history of market behavior in the past. Bringing the buyers and sellers of financial securities together, however, requires providing a place for a well-organized and orderly financial market where trading between buyers and sellers can readily take place. In the pre-computer age, financial markets required buyers and sellers to be represented by broker-dealers who would meet in a physical location, for example, the stock exchange, to engage in trades. The dealers who were members of these financial asset market exchanges recognized that at any given moment of the trading day, there may be a problem of getting a sufficient number of bona fides buyers and sellers together to maintain an orderly market. For the market to be well organized, it was necessary to adopt financial market rules that required all market participants to deal only with authorized broker-dealers that were permitted to execute trades in the specific marketplace. The broker-dealers acted as fiduciary agents for specific buyers or sellers to place orders with other members of the stock exchange, sometimes called specialists. Each specialist kept the books on all buy and sell orders for a specific security at any price. If, for example, at any time during the trading day, the number of sellers heavily outweighed the number of buyers at the last trade price, then to provide an orderly market price change from the previous trade price, the specialist was expected to act as a market maker and buy on his or her own account to limit the decline in price to a small orderly change from the previous transaction price. If, on the other hand, the number of buy orders far exceeded the number of sell orders, then the market maker would sell from his own portfolio in order to maintain an orderly increase in market price. Orderliness is a necessary condition to convince holders of the market-traded financial asset that they can readily sell, liquidate, for money their portfolio holdings of a specific security at a market price at, or near, the last transaction price. In other words, orderliness is necessary to maintain the belief in liquidity in these markets. Modern financial efficient market theory suggests that these quaint institutional arrangements for market maker specialists are antiquated in this computer age. The computer can keep the book on buy and sell order, and, it is claimed, the computer can match buy and sell orders and therefore maintain orderliness. With the computer and the internet, there will be huge numbers of buyers and sellers meeting rapidly and efficiently in virtual space. Consequently, there is no need for humans to act as specialist market makers to keep the books and to assure the public the market is orderly as well organized. Underlying this efficient market view of the role of financial markets is the presumption that the current and future value of traded financial assets is already predetermined by today's market fundamentals, at least in the long run. Former U.S. Treasury Secretary and Harvard professor Lawrence Summers has written that financial markets are efficient in that their ultimate social functions are spreading risks, guiding investment of scarce capital, and processing and dissemination the information possessed by diverse traders. Prices always reflect fundamental values. The logic of efficient markets is compelling for. In the numerous financial markets that became disorderly and failed in the winter of 2007 to 2008, the underlying financial instruments that were to provide the future cash flow for investors typically involved long-term debt instruments such as mortgages, or long-term corporate or municipal bonds. A necessary condition for these markets to be efficient is that the probabilistic risk of the debtors to fail to meet all future cash flow contractual debt obligations can be known to all market participants with actuarial certainty. With this actuarial knowledge, it even can be profitable for insurance companies to sell credit default swaps insurance to holders of these financial debt instruments, guaranteeing the holder would be reimbursed for remaining interest payments and principal repayment at maturity, if a default did occur. In the efficient market theory, any observed market price variation around the actuarial value price of the traded liquid security assets representing these debt instruments in the aforementioned markets is presumed to be statistical white noise. Any statistician will tell you, if the size of the sample increases, then the variance, that is, the quantitative measure of the white noise, decreases. Since computers can bring together many more buyers and sellers globally than the antiquated pre-computer market arrangements, therefore, at any point of time the size of the sample of trading participants in the computer age will rise dramatically. If, therefore, you believe in the efficient market theory, then permitting computers to organize the market will decrease significantly the variance and therefore increase the probability of a more well-organized and orderly market than existed in the pre-computer era. Consequently, efficient market theory advocates such as Summers suggest that the spreading of probabilistic risks for holders of these assets is much more efficient while the cost of each transaction is diminished significantly as computers take over for human order keepers. Underlying the efficient market theory, however, is a fundamental presumption, namely that the future is known and can be predicted on the basis of historical data. This presumes there exists an unchanging probability distribution governing past, present, and future events. Available information of market fundamentals are represented by historical data. Thus, if the probability distribution which is presumed to govern the past is also the same probability distribution that will govern the future, then historical data provide useful fundamental information regarding future earnings, payments, etc. If one accepts the classical assumption that the future is knowable and predictable, then as Summers states, the logic of efficient market theory is compelling. For believers in classical-based efficient market theory, the presumption that, at any moment in time, there is a plethora of market participants, buyers and sellers that can be collected by a computer assures that the assets being traded are very liquid. In a world of efficient financial markets, holders of market-traded assets can readily liquidate their position at a price close to the previously announced market price whenever any holder wishes to reduce his or her position in that asset. If the efficient market theory is applicable to our world, then how can we explain that in 2007 to 2008 so many securitized financial markets failed, in the sense that investors are finding themselves locked into investments they can't cash out of? 5. Keynes's liquidity preference theory can provide the explanation. Keynes' liquidity theory presumes that the economic future is uncertain and not actuarially predictable. Consequently, efficient market theory is not applicable to real-world financial markets. Keynes's analysis presumes that, in the real world of experience, the past activity of the macroeconomic and financial systems are not reliable guides to the probability of future outcomes. If future outcomes cannot be reliably predicted on the basis of existing past and present data, then there is no actuarial basis for insurance companies to provide holders of financial assets protection against unfavorable outcomes. Accordingly, it should not be surprising that insurance companies such as AIG that wrote credit default swap insurance policies to protect asset holders against possible unfavorable outcomes found themselves experiencing billions of dollars more in losses than the insurance companies had previously estimated. 6. In financial markets, it is impossible to develop insurance premiums that will cover estimated insurance payouts in the future. Nor will there be available fundamentals data providing market participants with an actuarial correct outlook about the future value of these financial instruments. In our uncertain economic world, the primary function of financial markets that trade in resaleable securities is to provide a place to store savings that possess liquidity. The degree of liquidity of the assets traded in any organized market will be enhanced by the existence of a credible market maker. As previously stated, a market maker is someone who attempts to create public confidence in the belief that there will always be an orderly resale market. In other words, in a market where a market maker exists, holders of the asset can be reasonably confident that they can always execute a fast exit strategy and liquidate their position in the asset at a market price that is very close to the last publicly recorded price. In essence, the market maker suggests to holders that if buyers do not appear to purchase offered securities at an orderly decline in price, then the market maker will make his or her best efforts to maintain orderliness, even if this requires the market maker to buy, for his or her own account, the securities offered for sale. If the market maker cannot support his or her assurance to maintain orderliness with sufficient cash when a cascade of sell orders come onto the market, then the market will fail, and the asset becomes virtually illiquid as trading will be suspended until the market maker can rally enough additional support for the buyer's side of the market to reinstate orderliness. This suspension of trading, if temporary in a well-organized market that is orderly, is typically called a circuit breaker. In other words, for an orderly liquid resale market to exist, there must be a creditable market maker who assures the public that he/she will swim against any riptide of sell or buy orders. The market maker must therefore be very wealthy, or at least have access to significant quantities of cash if needed. Nevertheless, any private market maker could exhaust his or her cash reserve in fighting against a cascade of sell orders from holders. Liquidity can be guaranteed under the harshest of market conditions only if the market maker has easy direct or indirect access to the central bank to obtain all the funds necessary to maintain financial market orderliness. Only market makers having such preferred access to the central bank can be reasonably certain they always can obtain enough cash to stem any potential disastrous financial market collapse. An interesting illustration of this market maker exercise occurred on the days following the terrorist attacks on the World Trade Center and the Pentagon on the 11th of September, 2001. As the World Trade Center buildings collapsed, there was a great fear that public confidence in New York financial markets and the United States government would also collapse. To maintain confidence in the US government bond market, in the 2 days following the attack, the Federal Reserve pumped $45 billion into the banking system. Simultaneously, since the primary bond dealers in New York tend to make the US government bond market, to ease cash concerns among primary dealers in bonds, which include investment banks that aren't able to borrow money directly from the Fed on Thursday, the 13th of September, 2001, snapped up all the government securities offered by dealers, $70.2 billion worth. On the next day it poured even more into the system, buying a record $81.25 billion of government securities. In effect, these actions of the Federal Reserve removed securities from the general public by making the market and providing easily available liquidity to financial intermediaries. These intermediaries could then also make the market by exercising purchases of all government bonds offered by members of the general public who wanted to make a fast exit. Furthermore, the Wall Street Journal reported that just before the New York Stock Exchange reopened on the 17th of September for the first time after the World Trade Center attack, investment banker Goldman Sachs, loaded with liquidity due to Fed activities, phoned the chief investment officer of a large mutual fund group to tell him that Goldman was willing to buy any stocks the mutual fund managers wanted to sell. The journal noted that, at the same time, corporations also jumped in, taking advantage of regulators' newly relaxed stock buyback rules. These corporations bought back securities that the general public had held, thereby making the market for their securities by propping up the price of their securities. In another case, on the 13th of March, 2008, the Federal Reserve worked out a deal via JP Morgan Chase to provide Bear Stearns with a loan against which Bear Stearns pledged as collateral its almost illiquid mortgage-backed derivative securities. This permitted Bear Stearns to avoid having to dump their mortgage-backed derivative securities onto an already set of failing markets in an attempt to obtain enough liquidity to meet Bear's repo loans obligations due on the 14th of March. Accordingly, Bear Stearns gained some breathing room and the selling pressure on financial markets were relieved. JP Morgan was the conduit for the loans to Bear Stearns because Morgan had access to the Federal Reserve's discount window and it is also supervised by the Federal Reserve. Bear Stearns did not have access and was not supervised by the Federal Reserve. Nevertheless, it was obvious on the 13th of March that if Bear Stearns failed and the collateral insufficient to cover the loan, the Federal Reserve and not JP Morgan would take the loss. On the Sunday evening of the 16th of March, the Federal Reserve and JP Morgan announced that JP Morgan would buy Bear Stearns for the fire sale price of $2 per share. Bear Stearns shares had closed at $30 per share on Friday the 14th of March. The Fed also agreed to lend up to $30 billion to JP Morgan to finance the illiquid assets it inherits from the purchase of Bear Stearns. In essence, the Fed was acting similar to the Resolution Trust Corporation, RTC, that dealt with the illiquid assets of insolvent savings and loan banks in the 1989 S&L insolvency crisis 9 by preventing the dumping of financial assets onto the markets to obtain cash. The Fed's action saved JP Morgan from having to dump Bear Stearns assets on the market to try to obtain enough cash to meet the Bear Stearns obligations. The post the 11th of September 2001 activities of the Federal Reserve flooding the banking system directly and other financial institutions with liquidity vividly demonstrates that the central bank can either directly or indirectly make the market in financial assets by reducing the outstanding supply of securities available for sale to the general public. The public could then satisfy its increased bearishness tendencies by increasing its money holdings without depressing the market price for financial assets in a disorderly manner, until, and unless, the public's bearishness recedes, the central bank and the market makers can hold that portion of the outstanding liquid assets that the public does not want to own. In sum, although the existence of a market maker provides a higher degree of liquidity for the financial assets, this assurance could dry up in severe sell conditions unless the central bank is willing to take action to provide resources to the private sector market maker or even directly to the market. If the market maker runs down his her own resources and is not backed by the monetary authority central bank indirectly, the asset becomes temporarily illiquid. Nevertheless, the asset holder knows that the market maker is providing his her best effort to search to bolster the buyer's side and thereby restore liquidity to the market. In markets without a market maker, there can be no assurance that the apparent liquidity of a financial security will not disappear almost instantaneously. Moreover, in the absence of a market maker, there is nothing to inspire confidence that someone is working to try to restore liquidity to the market. Those who suggest that one only needs a computer-based organization of a market are assuming the computer will always search and find enough participants to buy the security whenever there was a large number of holders who would want to sell. After all, in their theory, the white noise variation of buyers and sellers offers at prices other than the efficient price in efficient markets is assumed to be normally distributed about the efficient price. Hence, by assumption about the normal symmetrical distribution of buyers and sellers around the price, there can never be a persistent shortage of participants on one side or the other of financial markets. With the failure of thousands of auction-rate security markets in February 2008, it was obvious that the computers failed to find sufficient buyers. Moreover, the computer does not have funds and is not programmed to automatically enter into failing markets and begin purchasing to maintain orderliness when almost everyone wants to sell at, or near, the last market price. The investment bankers who organize and sponsor the securitized markets such as mortgage-backed derivatives, auction-rate securities, and other exotic financial assets did not, and would not, act as market makers. These bankers, often engaged in price talk before the market opened each day, tend to suggest to their clients what they believe the price range of today's market's clearing price will likely be. These price talk financial institutions, however, did not put their money where their mouth is. They were not required to try to make the market if the actual market price is significantly below their price talk estimate. Nevertheless, there are many reports that representatives of these investment bankers had told clients that the holding of these assets were cash equivalents. Many holders of these exotic securities believed their holdings were very liquid since big financial institutions such as Goldman Sachs, Lehman Brothers, Merrill Lynch, etc. were the dealers who organized the markets and provided the price talk. In an article in the 15th of February 2008 issue of the New York Times, it was reported, some well-heeled investors got a big jolt from Goldman Sachs this week. Goldman, the most celebrated bank on Wall Street, refused to let them withdraw money from investments that they considered as safe as cash. Goldman, Lehman Brothers, Merrill Lynch, etc. have been telling investors the market for these securities is frozen, and so is their cash. 11. Obviously, up until then, participants in these markets believed they were holding very liquid assets. Nevertheless, the absence of a credible market maker has shown how these assets can easily become illiquid. Had these investors learned the harsh realities of Keynes's liquidity theory, instead of being seduced by the dolce tones of efficient market sirens, they might never participate in markets whose liquidity could be merely a fleeting mirage. Should not US security laws and regulations provide sufficient information so investors could have made such an informed decision? Financial markets and regulation policy. The proper policy response to a financial market crisis similar to what occurred in 2007 to 2008 can be broken into two parts. First, what can be done to prevent future reoccurrences of this widespread failure of financial markets? Secondly, what, if anything, can be done to limit any depressing effects of a credit crunch developed in these securitized financial markets that do not have market makers but the public believed the holdings were as good as cash? The question of prevention is the easier of the two to answer. According to the web page of the United States Securities and Exchange Commission, www.sec.gov, the mission of the U.S. Securities and Exchange Commission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC web page then goes on to note that the Securities Act of 1933 had two basic objectives: require that investors receive financial and other significant information concerning securities being offered for public sales, and prohibit deceit, misrepresentations, and other frauds in the sale of securities. The SEC regulations typically apply to public financial markets where the buyer and the seller of a financial asset do not ordinarily identify themselves to each other. In a public financial market, each buyer purchases from the impersonal marketplace and each seller sells to the impersonal market. It is the responsibility of the SEC to assure investors that these public markets are orderly. In contrast, a private financial market would be where both the buyer and the seller of any financial asset are identified to each other. For example, bank loans are typically a private financial market transaction that would not come under the purview of the SEC. Normally there is no public well-organized resale market for securities created in private financial markets. The issued asset from a transaction in a private market traditionally has been an illiquid asset where the lender has skin in the game and therefore will not make the loan unless reasonably assured that the borrower will repay the interest due and principal of the debt, and in case of default, the lender hopes the debtor has possession of sufficient collateral as well. On its web page, the Securities and Exchange Commission also declares that as more and more first-time investors turn to the markets to help secure their futures, pay for homes, and send children to college, our investor protection mission is more compelling than ever. Given the current experience of contagious failed and failing public financial markets, it would appear that the SEC has been lax in pursuing its stated mission of investor protection. Accordingly, the United States Congress should require the SEC to enforce diligently the following rules. 1. Public notice of potential illiquidity for public markets that do not have a credible market maker. In the last quarter of a century, large financial underwriters have created public markets, which, via securitization, appeared to convert long-term debt instruments, some of them very illiquid, for example, mortgages, into the virtual equivalent of high-yield, very liquid money market funds and other short-term deposit accounts. As the newspaper reports that have been cited indicate, given the celebrated status of the investment bank underwriters of these securities and the statements of their representatives to clients, Individual investors were led to believe that they could liquidate their position in the market that possessed an orderly change in price from the publicly announced price of the last public transaction. Moreover, the AAA rating given by rating agencies such as Standard & Poor's to the securitized public market exotic assets added to the belief that these markets would always be very liquid. This perceived high degree of liquidity for these assets has now proven to be illusionary. Purchasers might have recognized a potential low degree of liquidity associated with these assets if the buyers were informed of all the small print regarding market organization. In markets such as the derivatives markets, for example, although the organizer-underwriter could buy for their own account, they were not obligated to maintain an orderly market, since the mandate of the SEC is to assure orderly public financial markets and require that investors receive financial and other significant information concerning securities being offered for public sales, and prohibit deceit misrepresentations. In the sale of securities, it would seem obvious that all public financial markets that are organized without the existence of a credible market maker should either 1. Be shut down because of the potential for disorderliness, or 2. At a minimum, information regarding the potential illiquidity of such assets should be widely advertised and made part of essential information that must be given to each purchaser of the asset being traded. The draconian action suggested in 1. above is likely to meet with severe political resistance, as the financial community will argue that in a global economy with the ease of electronic transfer of funds, a prohibition of this sort would merely encourage investors looking for higher yields to deal with foreign financial underwriters and markets to the detriment of domestic financial institutions and domestic industries trying to obtain funding. In the next chapter we will propose an innovative international payment system 12 that could prevent US residents from trading in foreign financial markets that the US deemed detrimental to American financial firms that obeyed SEC rules while foreign firms did not follow SEC rules. If, however, we assume that the current global payments system remains in effect, and there is a fear of loss of jobs and profits for American firms in the financial industry, then the SEC could permit the existence of public financial markets without a credible market maker as long as the SEC required the organizers of such markets to clearly advertise the possible loss of liquidity that can occur to holders of assets traded in these markets. A civilized society does not believe in caveat emptor for markets where products are sold that can have terribly adverse health effects on the purchaser. Despite the widespread public information that cigarette smoking is a tremendous health hazard, government regulations require cigarette companies to print in bold letters on each package of cigarettes the caution warning that smoking can be injurious to your health. In a similar manner, any purchases on an organized public financial market that does not have a credible market maker can have serious financial health effects on the purchasers. Accordingly, the SEC should require the following warning to potential purchasers of assets traded in a market without a credible market maker. This market is not organized by a SEC certified credible market maker. Consequently, it may not be possible to sustain the liquidity of the assets being traded. Holders must recognize that they may find that their position in these markets can be frozen and they may be unable to liquidate their holdings for cash. Furthermore, the SEC should set up strictly enforced rules regarding the minimal amount of financial resources relative to the size of the relevant market that an entity must possess in order to be certified as a credible market maker. The SEC will be required to recertify all market makers periodically, but at least once a year. To the extent that mutual fund managers who deal with the public wish to participate in financial markets that operate without a SEC certified credible market maker, then the fund manager must set up a separate mutual fund that only deals in such securities. These specific mutual funds must advertise in bold letters the aforementioned warning, and this warning must be repeated to every investor anytime he/she makes an investment in these mutual funds, as well as every time the investor receives a statement either electronically or by regular mail of his/her position in the specific mutual fund. 2. Prohibition against securitization that attempts to create a public market for assets that originated in private markets. The SEC should prohibit any attempt to create a securitized market for any financial instrument or a derivative backed by financial instruments that originates in a private financial market. For example, mortgages, commercial bank loans, auto purchase loans, etc. 3. Congress should legislate a 21st century version of the Glass-Steagall Act. The purpose of such an act should force financial institutions to be either an ordinary bank lender creating loans for individual customers in a private financial market, or an underwriter broker who can only deal with instruments created and resold in a public financial market with a credible market maker. What can be done to mitigate the depressing consequences of another financial crisis that still might develop in the future despite the SEC change in the rules? There are a number of policy steps that can be taken, including 1. The creation of a 21st century equivalent of the Roosevelt-era Homeowners Loan Association, HOLC, if the financial crisis is the result of a large wave of defaults in home mortgages, and the George H.W. Bush administration's Resolution Trust Company, RTC, to alleviate the United States housing bubble crisis and to prevent potential massive insolvency problems, and 2. The need for massive infusions in cash for financial institutions that are too big to fail. To a significant extent, the Federal Reserve through its quantitative easing, QE, policy has provided a version of providing massive infusions of cash for financial institutions and individuals. QE is an unconventional monetary policy of the central bank when liquidity problems and potential insolvency problems are preventing an economy from responding positively to ordinary monetary policy. QE involves the central bank buying significant amounts of financial assets, not only of government bonds but also often otherwise illiquid financial assets such as derivatives from commercial banks, other private institutions such as pension funds, and even from individuals. This buying of financial assets increases the prices of those financial assets and infuses the selling institutions' balance sheets with cash and liquidity, thereby simultaneously increasing the money supply and preventing selling institutions from facing insolvency problems. In this QE policy, from 2008 till October 2014, the Federal Reserve bought over $3.5 trillion of financial assets including securitized derivatives. The objective was to provide cash to large institutions which had on their balance sheets significant amounts of these financial assets that was losing all market value and becoming a toxic asset. Without QE by the Federal Reserve, the market price of many financial derivatives would have collapsed to near zero. Under accepted accounting rules, the financial assets have to be marked to market. Consequently, the value of the asset side of the balance sheet of these toxic assets would collapse, reducing or even wiping out most of the net worth of the holders of these securities. Notes: auction rate securities, ARS, are financial assets backed by long-term debts of corporations and or municipalities where the return paid are reset at frequent intervals through auctions. These auctions provide the primary source of liquidity for holders who want access to cash quickly. In recent years these auctions have failed and consequently holders were unable to liquidate. A credit default swap, CDS, is where the seller will pay the buyer of the CDS if a specified debtor defaults on a specific loan. The buyer need not own the specific debt certificate of the debtor. Consequently, CDS are often bought if one wants to bet the debtor will default. If the EMT is buttressed by the assumption of rational expectations, then expectations about the long run assure that short-run market prices do not get far out of line with their long-run fundamentals determine price. L. Summers and V. Summers, When Financial Markets Work Too Well, A Cautious Case for a Securities Transactions Tax, Journal of Financial Services, 3, 1989, page 166, emphasis added. Kim, Jane J. and Anand, Sheffield. Some investors forced to hold auction bonds. Market freeze leaves them unable to cash out securities that were pitched as safe. Wall Street Journal, the 21st of February, 2008, PD1. Morganson, Gretchen, 2008. Arcane market is next to face big credit test. New York Times, the 17th of February, PA1. Raghavan, Anita, Pulliam, Susan and Updike, Jeff. Team effort. Banks and regulators drew together to calm markets after attack. Wall Street Journal, the 18th of October, 2001, PA1. Raghavan, Anita, Pulliam, Susan and Updike, Jeff. 2001. Team effort. Banks and regulators drew together to calm markets after attack. Wall Street Journal, the 18th of October, PA1. The need for a revived resolution trust company to help solve the financial market crisis that was initiated with the subprime mortgage problem was emphasized in Davidson P. How to Solve the U.S. Housing Problem and Avoid Recession, a revived HOLC and RTC, Schwartz Center for Economic Policy Analysis. Policy Note, January 2008, online at http://eco.bus.utk.edu/davidson.html. Before the day's auction begins, the investment banker will typically provide price talk to their clients indicating a range of likely clearing rates for that auction. This range is based on a number of factors including the issuer's credit rating, the last clearance rate for this and similar issues, general macroeconomic conditions, etc. Anderson, Jenny and Bajaj, Vickers, New Trouble in Auction Rate Securities, New York Times, PD 4, the 15th of February, 2008. The proposed international payment system is a variant of the Keynes plan that was presented by Keynes at the Bretton Woods Conference in 1944 and rejected by the United States.